Cannabis stocks have been characterized lately by a lot of weakness that has been going on since they hit their all-time highs in April of this year. Looking at the charts here, these are the four Midas letter large cap, small cap, venture, and CSE indexes. These are all the companies that trade in Canada. So the large cap index is all companies trading over $500 million in market cap. And those are led by Canopy Growth, Aurora Cannabis, Kronos Group, and Curaleaf. Now, as you can see here, the all-time highs happened back in April. And since then, the bottom seems to have been reached on September 30th, and we've seen a bit of a bounce. All-time high happened back here in April, and the trend has obviously been consistently lower right up until this point, which is the 30th of September. And since then, we've seen a bit of a bounce here, and now it's sort of trending downward again. So at this point, the industry is best categorized as still being in a state of contraction. So for investors, the question has got to be, what stocks should we be looking at? And is it time to buy now, or should we be waiting until a better time occurs, namely a more decisive trend reversal to the upside? Fundamentally, let's discuss what's happening and what are the major influences on these stocks. So the biggest cause of the sell-off that began back in April is essentially the fact that all of the large companies that got capitalized throughout 2016 and 2015 have seen most of their shares become free trading. So the shares that founders hold, which are some of the biggest positions at some of the lowest prices, have now become free trading. And a lot of those companies are looking, or a lot of those individuals rather, are looking to monetize their positions by exiting in part or in whole. At the same time, all of the financings that were done in January, in the first part, Q1 of 2019, became free trading in April, which meant that all of those institutions who held positions catalyzed the start of the sell-off, because institutions typically are in the business of recycling capital. They are not investors. They want to sell the paper, ride the warrant, and cash in on the fees, and that's basically what started the sell-off. That created selling panic on the part of insiders who were afraid that the value they could get was going to be diminished, so they all moved to sell even more shares than possibly they had planned, which begot more selling, which begot more selling, and the resulting downtrend is what you see. Now, obviously, investors were dragged into that panic sentiment, and the whole market moved lower consistently. And then towards the end of 2019, the end of the third quarter, companies started announcing results, and there were several significant misses, especially by Aurora and by Canopy. Canopy did not meet expectations, and essentially all of the big companies failed to deliver on expectations in terms of what analysts had predicted would be the outcomes. So what happened? Selling pressure intensified, and the individuals with positions they could sell started to exit at any price, committing to the idea of remaining on the sideline until such time as the market reverses, because you can always buy your position back at that point. Right here, September 30th, we started to see some of the corrections, the corrections start to reverse as the news starts to get better, especially in the U.S. multi-state operator segment, where some of the sell-offs were more egregious. We saw disappointing news from Harvest Health and Recreation, who was expecting to have a non-dilutive debt facility at their disposal, which did not follow through. There was no comment from the company on why. We saw some strange trading on the part of Kronos Group. A large investor took advantage of some of the circumstances in that market to create confusion, sow confusion, and panic some of the short sellers into becoming short coverers. But essentially, there has been no solid good news The amount of bad news has far outweighed what little good news there was. The companies doing well are far fewer than the companies who are in trouble. So at this stage, at the beginning of the last quarter of the year, we are looking at the companies who have significant revenue from sales of cannabis and lots of cash on hand. Those are going to be the more attractive ones that you're going to want to start picking away at once a convincing reversal sets in. And it certainly looks like we may be bouncing along a bottom here, but it also looks like it could go a lot lower. So at this point, I'm suggesting that I'm going to keep out of the market. I'm going to keep my powder dry, so to speak, and I'm going to wait for more resolution on the bottom of the market, look for the beginning of an upward trend, and then start to rebuild positions in the names of companies with big revenue and solid cash positions. I'm going to stay away from the companies, regardless of the size of their revenue, who are burning through lots of cash, that don't have the capital structures or the relationships in place to access any more capital in this market where institutions have really pulled back from financing. And so those companies could be in a lot bigger trouble. The cost of their capital is going to skyrocket, making squeezing a profit a lot harder. Which names are those? Well, you're going to have to subscribe to the newsletter to find out. Thanks for watching.